What is EBITDA? Well, to begin with, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And it's a really useful number because it provides a way to evaluate a company without having to factor in financing decisions or tax environments or things like that. So it really shows what kind of income the operations of a company are generating. And so you may understand why interest and taxes would be deducted from something or would be added back in to find a number like EBITDA. But why are depreciation and amortization added back in? Well, this is because depreciation and amortization are costs that can't really be traced back to a particular period. So when you can't trace it back to a particular period, it doesn't help evaluate what the operations of a company generated during a particular period, because depreciation and amortization are overarching costs that are often spread out over numerous periods using equations, and it doesn't really tell you how much depreciation and amortization occurred during a particular period. So to calculate EBITDA, first you calculate something called EBIT, which stands for earnings before interest and taxes, and this is also known as operating income. So to calculate that, you take your earnings and you add back your interest and your taxes. Then you have EBIT. And so once you have EBIT, all you have to do is add back your depreciation and amortization to get EBITDA. So now I'll show a quick example of how to do an EBITDA calculation from the beginning. So in this example, we'll look at a company that has $1 million in earnings, $50,000 in interest, and $50,000 in taxes. So first we need to calculate EBIT. So to calculate EBIT, which again is also known as operating income, we will take the $1 million in earnings, add back the $50,000 in interest, and then add back the $50,000 in taxes, so we will have an EBIT of $1,100,000. Now let's say that this company has depreciation and amortization costs of $100,000 that were applied to the company during the period. We want to add it back because we couldn't really tell how much depreciation occurred during the period, and we really want to know what the operations of the company generated. So we need to add back the depreciation and amortization. So we take the $1,100,000 that we had calculated as EBIT, and we add the $100,000 of depreciation and amortization to it, and we'll get an EBITDA of $1,200,000. And if you have any questions, please leave them in the comments section down below. Don't forget to like the video if you learned something, and subscribe to the channel for more finance-related tutorials and videos, and thank you for watching.